And I'll explain in a minute what I mean by that when you give me an answer. What is a good working definition of risk? You want to try? What is it?
Something that will affect the likelihood you get your money back.
Something that will affect your likelihood that you will get your money back. Okay. Is that all you want to do, is get your money back? Because that seems like a pretty low threshold to meet, right? Because not only when you invest, do you see what I mean? Not only do you want to get your money back, because protecting principle is important. But I think it's important, but you're saying that's how you measure risk. So let me not reframe what you're saying. So you're saying, so to you measure risk is danger to principle.
Or also to your expected return.
Oh, and to your expected return. So you don't have to change your answer just because I pushed you on it, right? Because there is a value investing definition which is all about principle, which is if my principle is protected, then there's no risk. So that's not a bad definition, but if you want to protect returns too, that's fine.
It's the ratio between you losing all your money and what you want to get back.
Losing all your money. If you lose 90%, are you okay with that? Why all your money?
Because you still want to have some.
Okay, so ratio between losing all your money, what's the other half of the ratio?
And your side return.
Okay. So basically you're measuring your upside return against a chance you will lose all your money. Okay, fine. Any other definitions? Yes?
A mix of danger and opportunity.
Oh, come on, you're looking at the next slide. No, this is not right. But I'm glad you read ahead of me, so I'll come back and use my own definition on you later. Yeah?
What about the idea that your actual return is different from your expected return?
Actual return is different from your expected return. I'm going to put you on the spot here, though. Would you be okay if your actual return is much higher than your expected return? Do you see where I'm pushing you?
Yeah.
So you're saying that's risk for you as well?
No, that wouldn't.
Okay, so now you're changing your answer. The chance that your actual return will be lower than your expected return is what you worry about. What I'm trying to push you on is when I say risk, do you think downside? Because that's the way most of us think, right? And the reason I say finance classes ruin you for life is after you've spent a few sessions in a finance class, when I ask what is risk, and I'm glad I didn't get this answer, you say standard deviation, variance. No human being thinks about risk in terms of standard deviation. Not even Nobel Prize winners in economics. You know what risk is? It's that feeling in the pit of your stomach while you're sitting there watching the only stock you own melt down and you can't get through to your broker. That is risk. Until you felt it, you really haven't felt risk. Risk is an abstraction. That's why when you have an extended good market, people can talk about risk, but they really don't get it. You need a crisis, a bear market, to remind you. And that's why quarters like the last quarter of 2018 are good. You're saying, what do you mean good? It was horrific. I lost 15% of my portfolio. That's good because it reminds you of what risk is. So I'm going to use a definition that was already used on me and talk a little bit about how I think the best definition of risk I've ever seen is actually the Chinese symbol for crisis. You know what? I've been corrected 50 times. I keep changing it and then somebody corrects me again. So that's not, I know no Chinese. So let me be upfront about it. This could be something obscene as far as I know. So I'm going to pretend, I've been told that this is the Chinese symbol for crisis or big risk. And it's a combination of two symbols, danger plus opportunity. To me, it's a perfect definition of risk. You know why? Because it connects the two. It says if you want one, you've got to live with the other. Who amongst us doesn't want opportunity? We all want to make 70% returns, right? But this says if you want to make 70% returns, be willing to live with a lot of danger. Oh, you don't like danger? Don't ask me for 70% returns. Think of how many mistakes in investing we would avoid if we remembered this. Every scam at its heart, what does it offer? Whether it's Bernie Madoff or Ponzi, it is you can make a lot of upside. You can get a lot of opportunity with no danger. And this is a reminder that that cannot be. To show you what happens when you lose that connection. Anybody here from Orange County, California? Don't worry, I'm not going to pick on you. I like Orange County. You're from Orange County, California? Great place to live. Sun's always out. There are no more orange groves left. The real estate is too expensive, but it's still Orange County. And Disneyland is around the corner. But 25 years ago, Orange County, at that time one of the wealthiest counties in the United States, declared bankruptcy. You know why? Because the pension fund, the county pension fund, the treasurer of the county pension fund had taken 1/3 of the fund's money and I'm not making this up, decided to speculate on German interest rates. As I said, you can't make this stuff up. Now, speculation is great if you make money, but speculation is horrific. In this case, he lost the money. Pension fund declares bankruptcy. Huge scandal. So this guy, whose name was Robert Citron. I think everybody in Southern California changes their name. I mean, come on, Orange County, Citron. This is too much of a coincidence. This is like Wolf Blitzer, defense correspondent. I don't think that's Wolf's real name, but it sounds so good, right? As you're the CNN, journalists covering, wars. You can read Wolf Blitzer. Robert Citron, and he's on 60 Minutes being interviewed by a legendary 60 Minutes interviewer, Mike Wallace. So Mike Wallace asked him, Mr. Citron, why would you take 1/3 of pension fund money that's supposed to be invested in safe assets and speculate on interest rates in Germany? And Robert Citron said, because Charlie Clough told me I could make 15% with no risk. To which your response is, who the hell is Charlie Clough and why is he telling you these things? He was Merrill Lynch's market strategist in 1992. And which is part of the reason Merrill Lynch became a co-defendant in this lawsuit that emerged out of this. Yeah. I don't know Mr. Clough, but I do know market strategists. There is no way that a market strategist will ever say something as direct as you will make. Market strategists are masters of misdirection. You listen to a market strategist for an hour, you have no idea what he or she said. At the end of the hour, you say, did she say that markets would go up? I think she did. Did she say markets would go down? I think she did that too. The markets would stay flat? Yes. They're incredibly mushy characters. But let's assume that Charlie Clough, in a moment of honesty or drunkenness, told Robert Citron, you can make 15% with no risk. Let me return to the interview. Here's what Mr. Citron says. He's the treasurer of Orange County. He says, and I'm not a finance person. Turns out that the treasurer of Orange County is an elected position, so he was elected to that position. Right? But let me ask you a question. Do you have to be a finance person to know that if somebody comes up to you and says you can make 15% with no risk, that they're lying? If you're thinking too hard about are they really lying, you probably also think that Rolex you bought last week on Canal Street for $45 is really a Rolex. I mean, take a look at the spelling. It says R-O-L-E-C-K-S. You pay $45 for a Rolex, it's not a Rolex. You pay $5 for a Mickey Mantle rookie card, it's not a Mickey Mantle rookie card. Danger plus opportunity. Reminder that you get every time you see a scam play out. If you look at the Bernie Madoff scandal, he actually was clever. He didn't offer 15% because that would look too greedy. He said, you can make 8% with no risk. And people said, I'm not being that greedy. You still are. You just don't notice it as much. But at the heart of every scam is this promise of you can have lots of opportunity with no danger. The other good aspect of this is risk is neither good nor bad. It's upside and downside. And the key to remember here is in finance, we're not bungee jumpers. We don't take risk for the sake of taking risk. We take risk because we're going to get rewarded with some kind of opportunity. And one way to think about risk and return models is they try to measure the danger in an investment and say, this is how much opportunity you need to compensate for taking this danger. Are you getting that opportunity? That's what risk and return is. So let me lay out 5 things I look for in a good risk and return model. And then we'll start looking at the existing models to see if they meet these criteria. A good risk and return model should come up with a measure of risk that applies to all assets. Why? Because you're an investor. You can buy stocks, you can buy bonds, you can buy real estate. So you want a measure of risk that cuts across assets. Because if I have a measure of risk that works only for Indian stocks, then how do I decide whether to buy that stock or a Chinese stock? If I have a measure of risk that applies only to stocks, how do I measure them up against bonds? So I need a measure of risk that is universal, that cuts across all investments. Second, I need a risk and return model that tells me what types of risk I will get rewarded for and what types of risk I will not be rewarded for. You're saying, why would I not be rewarded for taking risk? Let me give you an extraordinarily stupid example so you can get the point. Let's assume you decide to you decide to invest in stocks, and you decide to buy a house across a 6-lane highway. And your brokerage house is on the other side of the highway. And every morning, here's what you do. You get up and you run across 6 lanes to get to your brokerage house. At the end of the year, you come to me and say, I took a lot of risk this year. I could have been run over 350 times, but I made it through. I should have made a high return, right? It's absurd. You're taking on risk, but it's risk you could have avoided. We'll make this a less stupid example as we look at risk that you will get rewarded for, risk you will not be. But I need a model that says, these are the risks you can take that you will get a reward for, and these are the risks that you take that you will not get a reward for, but you can choose to take them if you want. Third, I want to be able to come up with a risk measure from this model that's standalone. And let me again give you an example of a non-standalone measure. If I told you that the variance of a stock is 43%, or a standard deviation is 25%, and then I asked you, is this a risky stock? What's your reaction going to be? I have no idea. What do I compare it to? Is it 20%? Is it 15%? Standard deviations are not standalone risk measures unless you have in your mind a histogram of standard deviations of every stock, in which case you're a very strange person. So you need a risk measure that's standalone. Where if I give you that risk measure, you can take one look and say, hey, that's a high risk stock, that's an average risk stock, that's a low risk stock. Third, that risk measure that I come up with has to be translatable into an expected return. Why? Because I need hurdle rates. I need a benchmark. So once I come up with a risk measure, say what return goes with that, you need to say 15%, 18%. And finally, this might be asking for a lot, but I need a risk model that actually works. In what way? It works in explaining differences in returns across risky assets. That is what a perfect model would look like. So I'll give you the bad news. There are no perfect models. But let's go back to the oldest risk and return model in use in finance. It's still the standard in most places. It's the capital asset pricing model. Let's see how it goes through these 5 steps. In the capital asset pricing model, we define the variance in returns as a measure of risk. And we're going to talk about the limitations of doing that, but we define risk in terms of variance. The capital asset pricing model also says that only the portion of that variance that cannot be diversified away will get rewarded. And we'll see the rationale that lets you get to that point. It measures that portion of variance that you cannot diversify away with a beta. And you see why a beta is standalone? What's the average beta across all stocks? It's 1. So if I give you a beta 1.2, I don't need to tell you whether the stock is riskier or safer than average. Any number greater than 1 is riskier. Any number less than 1 is safer. And once I have the beta for a stock, I can plug it into a model where I can take the risk-free rate plus beta times the price of risk in the equity market, called the equity risk premium, and I can come up with an expected return. So far, we're coasting, right? Looks like this model is great. Here comes the catch. It doesn't work very well. Which leaves me in an unpleasant place because I'm going to use the CAPM for the rest of this class, so I have to give you my justification for why I'm sticking with a model that doesn't work very well. But let's go through these steps so at least we can get a sense of what drives the model. You might have seen a derivation of the CAPM in your foundations class, but that's mostly with indifference curves. I'm not going to use a single indifference curve, no equations, no. So I'm going to use a purely intuitive way of backing into the CAPM. So let's start with the basis for the capital asset pricing model. In fact, almost all risk and return models in finance. It's called the mean variance framework. Sounds fancy, but the good stuff is your expected return. That's the mean. The bad stuff is the risk measured with the variance. So the mean variance world, here's what you look at. You look at the expected return on investment, and you look at the standard deviation of the investment, and you make a judgment on whether you want to invest in that stock. So to make this concrete, if I took Disney, for instance, and I asked you what the standard deviation is, it's easy to compute, right? It's a traded stock. I can look at the prices, and I can give you a standard deviation, but here's the catch. I can give you a standard deviation for the last 2 years, the last 5 years, the last 10 years. Why is that a catch? What do I really want when I invest? I want a standard deviation for the future. This is a conundrum in all of finance. All our data is in the past, but all our worries are about the future. We make a leap of faith. We say, if I know what the standard deviation is over the last 2 years, that is a good estimate of the standard deviation the next 2, which might not be a bad assumption for Disney, but it'll be a horrifically bad assumption if I'm looking at a company like Tesla. Why? Because companies change over time. And when you're looking at a mature company, making this assumption of past standard deviations and good estimates of the future is not a bad assumption, but when companies are evolving, and sometimes it might not even be the company's fault. The markets they're in might be evolving. The businesses they're in might be evolving. Using past data is going to get us into trouble. We'll come back and confront what to do about this issue, but clearly that's an underlying issue. But do we live in a mean variance world? Is that what we as investors care about, expected return and standard deviation? Let me put you to a test. Let's assume I come to you with 2 investments. They have exactly the same expected return and exactly the same standard deviation. So if you lived in a mean variance world, what should be true? You should be indifferent across those 2 investments, right? But let me add a couple of things about these investments. Let's see if it might affect your decision as an investor. Think like an investor. So here's the first one. Even though investment A and B have the same expected return and standard deviation, there is a very small chance that on investment A you could quadruple your money. It's built into the expected return, but there's that possibility of quadrupling your money. And your best case scenario with your investment B is that you make a 60% return. So the expected returns and standard deviations already reflect these possibilities, but I've thrown that out. There is a chance you could quadruple your money with company A, but the best you can do with company B is a 60% return. There's no right answer. So basically don't look at the textbook and say, what's the right answer? This is coming from your gut. I want you to tell me whether this might affect a decision. So how many of you would still be indifferent between the 2 investments now that I've added this qualifier? We're in big trouble, don't you see? We're going to build a model built on the mean variance framework, or whatever you just told me. None of you lives in that world. Because in that world, you should have been indifferent. How many would prefer investment A because of that small chance of quadrupling your money? This is called the lottery effect, right? The reason, what's the expected value of playing the lottery? It's negative because by definition, it's not 0 because the government actually, when they run lotteries, tell you that 30%, they lie about where the money goes, but basically, I think in New York it's like 50% of the lottery money in theory is supposed to go into education. So your expected return is minus 50%. If you lived in a mean variance world, you would never buy a lottery ticket, right? But why do people do it? Because there's this very tiny chance you could make 100 million. Now do you see why lotteries like to make the price bigger and bigger and bigger? Because then they can make the expected return more and more negative and you're still playing. It doesn't make you irrational. It reflects the fact that your preferences, that factors in. What is the chance I could make a lot of money? In statistics, this is called the skewness of the distribution. Basically, it looks at the tail of the distribution. What is the chance I could make a really large, and investors like positive skewness. In fact, this is the argument that people use for why, if you look at small cap stocks, you might accept a lower return than on large cap stocks because there's a greater chance you could double or triple your money. It explains why we invest in young startups as VCs. Your expected return might not be that great, but the payoff when you succeed could be huge. Now let me change the facts. Let's go back to the original example. 15% expected return, 25% standard deviation. Let's take out the quadrupling effect, 60% effect. But let me add a different qualifier. Let's assume that on one of these investments, an investment A, there is a chance, and this goes back to your definition of risk, that you could lose 100% of your money. But investment B, your worst case scenario is you can lose only 50%. Might that affect your choice? Absolutely. We worry about downside risk. We worry about principal. What I'm trying to say is none of us lives in a mean variance world. You're not unusual. This is true across investors. Very few investors pick investments based on just expected return and standard deviation. So you're saying, why do we stay with that? Because as you go to portfolios, as you start looking across investments, it turns out that your returns start to get more symmetric. You see what I mean by that? You buy one small stock, there might be a chance you could quadruple your money. You buy 30 small stocks, your distribution becomes more balanced because you could have one stock quadrupling the money, but not all of your stocks are. So the first thing that happens is if you look at portfolio returns, this becomes less of an issue. And second, building in things like skewness into your expected returns. People have tried. You end up with models that are more realistic, but they end up being models for which getting the inputs gets really difficult. So here's what I suggest. Don't defend the mean variance framework too strongly because it's indefensible. That said, though, we're going to stay with the mean variance framework and accept the fact that it's going to give us some expected return estimates for certain kinds of investments. Investments like investment A, where you could quadruple your money, which are perhaps a little too high, because you would have accepted an expected return lower because you want that quadrupling effect. Now let's talk about diversification. Talking about diversification to value investors, for instance, like waving a red flag in front of a bull. It sets them off. It's a trigger word, diversification. Oh my God, you can't do that in here. Because the notion in value investing is you should buy 5 companies, you should do your research, just buy 5 companies, that take care of it. In fact, the arguments used against diversification often are, do you want to diversify or do you want to pick stocks, as if they're mutually exclusive? I pick stocks from a portfolio, but I try to be diversified. Because you don't need to own 43,000 publicly traded stocks to be diversified. You might need only 30 or 40 to get 95% of the way there. So this is not a question of do you want to diversify, do you want to pick stocks. This is really a question of what does diversification do for your portfolio? And what diversification does for your portfolio is a purely statistical, law of large numbers thing. And let me explain. We're talking about Disney, right? Let's think about all the potential risks that Disney faces in the coming year. When's the next Avengers movie coming out? April, right? Huge. So somebody's keeping track. You probably know the date as well. You know, you got it circled on your calendar. You're going to stand in line. It's probably going to be a $300 million movie. Is there any risk that Disney could lose money on that movie? You're saying no chance. No Marvel movie has ever lost money. It's a good track record, but what if in this movie Thanos never opens his hand and the Avengers stay dead? I can almost guarantee you the movie's going to crash and burn. So the first risk is the next big budget movie that Disney has could crash and burn. And if it does, is Disney going to be affected? Yes, its financials are going to be affected, stock price is going to be affected, but the effect is going to be primarily or only on Disney. You're saying as opposed to what? Disney is in the broadcasting business, right? Now, especially as it's acquired Fox, it's got all these. To the extent that broadcasting regulations can change, Disney is going to be affected in positive or negative ways as those laws change. So the FCC says you can own 3 stations in a city, you're no longer restricted. Well, Disney is going to be affected, but so are other companies in the broadcasting business, which might be 10, 15, 20 other companies. So now we've gone from risk that affects one company to risk that affects 10 or 15 companies. Let's keep moving. Let's assume that Disney has a significant percentage of its revenues coming from outside the US. I think in the most recent financial year, it was like 25 or 28%. If the dollar strengthens, are Disney's numbers going to be affected? Yeah, I'm going to ask whether it's in a good way or a bad way. They're going to be affected. But is Disney the only company that's going to be affected by a stronger dollar? No, there are probably 2,000, 3,000 companies. A third of the US market is probably affected in good ways or bad ways. Some are helped, some are hurt. So now we've gone from risk that affects one company to 20 companies to maybe 3,000 companies. Is the Federal Open Market Committee meeting today? I think it is. This is the Fed's policy-making board. And when it meets, Wall Street comes to a standstill, and everybody watches the screen intent on smoke signals. I think the Fed should go to smoke signals, if you ask me. It might be more revealing. About what? About what they will do to interest rates. So the Fed comes out and says, inflation is going crazy, you never even noticed. It doesn't even have to say anything else. What else is going to follow? Well, people are going to read into that. They're going to raise interest rates. It's terrible for... And Disney is going to be hurt, but so is every stock in the market, right? Because there's no stock that's immune from interest rates changing. It's not just that your income is a function of interest rates, but also the fact that when I value your stock, interest rates come into play. We've gone from risk that affects one company to 20 companies to 2,000 companies to every company in the market. You're saying, so what? If you put all your money in Disney, which of these risks are you exposed to? All of them. But to the extent that you diversify and hold 20, and again, by diversifying, I'm not saying go crazy and buy every single stock in the market. I'm saying go out and own 40 or 50 companies cutting across sectors. You're not protected, but you can see now how risk that affects one or a few companies start to average out. And they average out for two reasons. One is a purely math reason, which is now Disney's 1/40th or 1/30th of your portfolio. If something bad happens or something good happens, you don't notice as much. But there's an even stronger reason. When I talk about risk that affects one or a few companies, remember that risk can cut to the upside for some companies and to the downside for others. So when I own 30 companies and I open up the news and I might see good news on one company and bad, the risks that cut across companies are going to cut in different directions and going to start averaging out. Every day when I open, I don't get the physical Wall Street Journal anymore. I get the online edition. I go through varying stages of joy and despair as I read through, because I read about a company that I own on page one and say, this is great. Netflix, or in this case, let's assume GE has just announced that it's found a buyer for a division that nobody thought could sell, GE Capital. My stock is up 15%, but before I celebrate, I get to page 7, and I read about Apple, about how their iPhone XRs might need to get recalled. It's not a real story, so don't freak out. And the stock is down 7%. Do you see what I mean by this? Unless God has it out for you, if you own 35 stocks, you're not going to see bad news on all 35. You're going to see a mix of news if it is company specific. So risk that affects one or a few companies will get averaged out. You don't need statistics to even see this. It's pure averaging where different things cut in different directions. So diversification reduces that exposure to firm-specific risk because it averages things out. So here's where things get interesting. One of the links I sent you, one of the links that did not work in the morning but worked at night, was actually a link that looked at how many stocks a typical investor, an active investor, most investors in the US now own money through index funds, but if you're an active individual investor, this study looked at how many stocks does a typical individual investor hold in their portfolio? I know all of you have read the paper, and I know you know the answer, so I'm going to give you the answer, because why make you tell something you already know? The average number is about 3 to 5. What does that tell you? The typical individual investor is not diversified. Already we're on to the second assumption in risk and return model. The first one didn't work. Now we're on to the second one. It looks like we're making another unrealistic assumption, right? But here there is an escape clause. We don't all have to be diversified for this process to work through. Because what do we mean by this process to get rid of that risk? All we need is the marginal investors in companies to be diversified. You think, what does that mean, marginal investor? The marginal investor is the investor who can affect prices, which already means that I was going to say all of us, but I want to insult you if you're a multi-billionaire. But most of us cannot be marginal investors. Why? I own 1,000 shares of Apple. There is nothing I'm going to do to the price by buying, selling, holding, nothing. Basically, I'm a non-entity. And most of us are. We cannot affect prices because we're not big enough players. So to be a marginal investor, there are two things that have to come into play. One is you need to be talking about millions of shares, not thousands of shares. So you need to own a lot of shares. And second, to affect prices, what do you need to do? You need to trade those shares. So if you own shares and you never trade them, you can't be a marginal investor. You need to be a marginal investor. To be a marginal investor, you've got to own a lot of shares and trade them. Remember that HDS page that some of you have printed off for your companies? One reason I asked you to print it off is to look at where does the power lie in this company, right? But here's the second reason that page comes in useful. Your marginal investor is on that page, right? Because those are your biggest investors. And the question you're asking is, are those investors likely to be diversified? Remember on the Disney page, who was on top of the page? Lots of institutional investors, right? Fidelity, State Street, Barclays. Are they likely to be diversified? I think we're on pretty safe ground. So when we think about marginal investor, we're looking at that page. You're saying, what if Mark Zuckerberg is at the top of the page, like for Facebook? Mark Zuckerberg is not the marginal investor in Facebook. You're saying that's absurd. He owns 20% of the shares. He does own 20% of the shares, but what does he not do? He doesn't trade. Larry Ellison was the largest stockholder in Oracle, still is, owns 25% of the company. This is actually one of the great ironies. You can be the founder, you can be this incredibly powerful shareholder, but you're still at the mercy of what other people think about you, as Facebook is finding out over the last year. The marginal investor, you need to own a lot of shares and trade those shares. And in all risk and return models in finance, we make an assumption that that marginal investor is diversified. Why is it an assumption? Because there are some companies, we look at the top 17 investors, especially if they're small emerging market companies, they might all be individuals. In which case, assuming that the marginal investor is diversified is going to get into serious trouble. We'll talk about what to do when we run into those scenarios. In fact, we'll take an extreme scenario of Bookscape, small independent bookstore owned by one person. Who's the marginal investor? Probably another person trying to buy the company. Is that marginal investor going to be diversified? There's probably no chance of that. So when you talk about private companies, clearly this assumption doesn't even hold. But with public companies across the world, especially the larger cap or even mid cap, this is a fairly reasonable assumption. So one of the stops that you need to make when you look at your company is to make this judgment. Is the marginal investor in my company likely to be diversified? Why? Because if they are diversified, then you can focus only on the risk that you cannot diversify and measure that risk. If they're not diversified, then we have a problem. So you can look at the top 17 investors in your company, but here's the other thing I would look at. It's public information as to what percentage of your company is held by institutions. Disney, for instance, 77% of the shares are held by institutions. So already I can tell you that I'm on pretty safe ground, assuming that the marginal investor in Disney is an institutional investor. So if the percentage held by institutions is high, then you're going to get an institutional investor be the marginal investor who's diversified. And even if there's an individual who's a high stockholder, he might influence a process, but it's still the institutional investor who drives it. But for some of your companies, when you look at that percentage, it could be a low number. So let's look at the possibilities. If the percentage held by institutions is low, and the percentage held by founders or managers is high, it's tough to tell without looking at the trading on the stock. So I'll give you an example. We're going to look at Tata Motors. And a big chunk of Tata Motors stock is held by the Tata family through the group and through. But when you look at the trading on Tata stock, even though institutions might own only 47% or 50% of the shares, they account for 95% of the trading. So by looking at who's doing the trading, you can form a judgment. But you need to look at whether the trading is coming from the individual or the institutions. So when you look at a company, you're looking at percentages held by institutions, percentages held by individuals. If the individuals are founders or managers, they're unlikely to trade because by trading they give up control. If it's a wealthy individual, then you might have to make a judgment on, is that wealthy individual putting all of his or her money into the company? Are they so wealthy that they can be diversified as well? So Paul Allen, for instance, when he was the co-founder of Microsoft, he recently died. He owned the Portland Trail Blazers. He owned 15 other companies. He was a wealthy individual. So if he showed up on your list, well, he's pretty much diversified as well. And finally, if you have low institutional holding and low insider holding, then you are in deep trouble, because then you have individual investors who are driving the bulk of the trading on the stock. And as we said, individual investors often, for whatever reason, end up not being diversified. Okay. So let me take Disney moving forward to 2013. Right? So you saw Disney in 2009 when Steve Jobs was the largest single stockholder in Disney, right? We moved across. Okay? Now this is Disney in 2013. Steve Jobs has passed on. His Laurene Powell Jobs is now the largest shareholder. But you have a new name that's popped up as an individual. It's George Lucas. And that was the Lucasfilms acquisition that happened between 2009 and 13. But the rest are all institutional investors. You're saying, shouldn't Laurene Powell Jobs now be the marginal investor? She's not, because you look at the percentage of the shares she owns, it's pretty much the same percentage you saw in 2009. She hasn't traded very many shares. And George Lucas might have gotten pissed off after Star Wars 7 and tried to sell his shares. But at least at the moment that I looked at this, he was still a kind of shareholder in long standing. The remaining people, though, will come and go. One of the reasons, in fact, I think yesterday somebody emailed me saying, I looked on Bloomberg for the top 17 stockholders in my company, and then I looked at Yahoo Finance, and the lists are different. You know how Bloomberg and Yahoo Finance get these numbers? They don't have proprietary information. In fact, none of the information you get on companies, at least in the US, is proprietary. It's pulled from SEC filings. And often it's the same type of filing, but the timing can be different. So if you pull the data 2 months after me, and because different services use different dates for pulling the data, you can get a very different list, because State Street can be the largest shareholder in February, and by March or April, it could be BlackRock. So things move around on this list. But the key is, I don't care about the names on this list, I care about the type of investor. And you look at the remaining 15 on this list, they're almost all institutional investors. Some are pension funds, some are mutual funds, but what do they share in common? They're diversified. And that is all I want to get out of this table is, hey, are they diversified? I'm on pretty safe ground. But as I said, for my other companies, it's trickier. For instance, if you look at Disney, 70% was held by institutions in 2013. 21% was held by institutions, 7.5% by insiders. And the primary insiders were, Steve Jobs and Laurene. So basically, those were classified as insiders. Deutsche Bank has a far higher percentage held by individuals. So I was a little worried about that, but then I looked at the trading, and it turned out that the 59% held by institutions translates into almost 90% of the trading. So I felt pretty okay with the institutions being the marginal investor. Vale, if you look at the preferred shares, 71% are held by institutions. Remember, Vale has two classes of shares, right? The common shares are the voting shares. They're held by 8 entities that never trade. So in a sense, they can't be the marginal investors. It's the preferred shareholders who actually set the market prices. So 71% institutions. Again, I'm on safe ground. Tata Motors, much higher percentage of insiders, simply because you have that cross-holding structure. But again, even though institutions account for only 41% of the outstanding shares, they account for the bulk of the trading. The trading is what drives the decision making here. So I think for all of my companies other than Bookscape, and this includes Baidu on the list, institutions are driving the process. I'm not saying institutions are rational. None of those leaps of faith. All I'm saying are institutions diversified. If they're diversified, then I'm home free. I'm on pretty safe ground with all 5 of my publicly traded companies. I'm definitely not on safe ground with Bookscape, my private business, but we'll come back and deal with it separately. Now, will that be true for you? For most of you, after you've gone through this assessment, you're probably going to say, I'm on safe ground too. But for some of you, at the end of this process, you might still be saying, look, I picked a small company. It's got almost all individuals on the list. What do I do now? don't worry. For the moment, kind of act like it's publicly traded and its marginal investors are diversified. We'll come back and talk about how you might want to modify their hurdle rates to reflect the fact that investors are not diversified in the company. Now let me go, yeah, go ahead.
In terms of looking at investor behavior, do you care about active managers versus passive?
Yeah, they all diversify. Again, at this stage, I don't care, right? Because in a sense, whether you're active or passive, basically you are in fact part of my base. Active managers are more likely to affect the prices because they trade more often. So there is that limiting cases. As passive managers become more and more of the market, are the marginal investors going to be the 20% active managers who are in fact driving prices? And that is one of the worries about so much of the money being passively run, is you might be giving disproportionate weight then to those active managers who end up being the survivors in this game. Okay? But at this stage at least, it's not that big of a problem, but it could very well. 10 years from now, if I'm teaching this class still, this might be an issue. What percentage are active, what percent are passive? Because I want to separate the Vanguards and the BlackRocks of the world from the Janices, the Fidelities of the world. Yes?
Would it get a firm that had large holdings by like venture capitalists or private equity
That's-
firms who are not institutions, but they're sophisticated investors?
It's actually a very good question. Venture capitalists originally were not diversified, and the reason was not because they didn't hold a lot of companies, but they often tended to be in a sector, right? Private equity is different. It's evolved differently, right? Because originally private equity was maybe three, but if you're a KKR or a Blackstone, you're as diversified. And what happens, and this is I think one of the realities of the markets, is more diversified investors will push out less diversified ones. You know why? Because they offer a higher price for the same investment because they see less risk in the investment. So private equity increasingly is getting more diversified. And venture capitalists play a very strange game, which is they don't manage the company from their perspective. What's the definition of success for a venture capitalist? They invest in a company, they have to, what's the exit? They sell it to a publicly traded company, they take it public. So they often have to put their risk perspectives to the side because they want to manage the company for that exit. So even venture capitalists who are not diversified, if they're sensible, have to think about exit strategies. And those exit strategies are to markets where you have diversified investors. So it's a much trickier game because for those 2 or 3 years where it's a private business, you're exposed to significant risk that you're not covering, which is part of the reason they demand that 50% target rate of return or whatever they demand of you. But that's, I think, that gray space that's getting filled up now as venture capitalists start to get more diversified private equity. You're starting to see a convergence across these different markets. Okay. Any other questions? Now, let me go back to the argument for diversification. It's a purely intuitive one, right? That you should, I mean, you got these problems. Don't put all your eggs in one basket. Well, who came up with that? I don't know. Probably around hundreds of years. That's a diversification argument, right? They didn't do a mean-variance framework or do a covariance. They said don't put all your eggs in one basket because if you drop the basket, all your eggs break at the same time. So this argument for diversification is an intuitive one. So if I own one stock, I should add a second one. If I own 2 stocks, I should add a third one. But most of us stop diversifying at some point. I'll start, I don't know how many stocks you have in your portfolio, but I'll tell you how many I have in my portfolio. I counted last night. I have 53. But I have only 53. You see, what do you mean only 53? There are 43,000 publicly traded stocks. I stopped at 53. So why did I stop at 53? Give me the cruel answer first and the less cruel answer later. What's the cruel answer? Because you don't have enough money. Okay, we got that out of the way. You're right, I don't have billions. What's the other reason I stopped? Because I think I can pick stocks. This might be a complete delusion, but there are 2 reasons people stop diversifying. Because even a Fidelity Magellan that has no excuse, right? It is $100 billion plus, stops at 150 stocks. Most of us stop diversifying at some point. Okay? Either because we run out of money or because we face this problem. We think we can pick stocks. You know what the first 2 assumptions of CAPM are? First, there are no transactions costs. So adding a stock is costless. Second, there is no private information, which is a euphemism for you can't pick stocks. So if you have no transactions costs, and you can't pick stocks, when should you stop diversifying? Remember, every additional stock will always, even if it's the 15,000 stock in your portfolio, will reduce risk less than the previous one. The marginal benefits get lower, but they never get below zero. So if you lived in a world with no transactions costs and you can't pick stocks, you know when you'd stop? Never. You'd keep adding every single traded stock in the universe into your portfolio. You're saying, this is absurd. Hang in there with this absurdity. You won't stop there. You buy every traded bond, every piece of traded real estate. In fact, you'll end up with a portfolio of every single traded asset in the market held in proportion to its market value. So what should we call this portfolio that has everything in the market in it? Let's be creative and call it the market portfolio. And in the CAPM, that's where we all end up. I know it's a completely unrealistic world, but let's act like we're the world. We are the world. No, that's a song. So never mind. Let's say we are the entire market. We all have no transactions costs. We can't pick stocks. Every one of us is going to end up. So if you have trouble grasping this notion of a market portfolio, think of it as a gigantic index fund that is every single traded asset. We're not that far away from that reality, right? A Vanguard all-market fund with an 800 number, if you're old-fashioned, or an online account. So here's what each of us would do. Your money to invest. We're not picking stocks. We're just going and putting it in the... You're saying, but how do we then differentiate across people? Because some of us want to take a lot of risk. Some of us want to take less risk. Some of us want to take no risk at all. So I'm going to pick on three people. Let's say you want to take no risk. Even if you're risk averse, act like you want to take no risk. You want to take some risk. You want to take more risk. Remember, there are only two choices in this world. One is how much money you put in this index fund, and the other is how much money you leave in something riskless. Assume there's something riskless, a money market fund. So what is your allocation going to look like because you want to take no risk at all? You put all your money in the money market fund and you walk away. You put half your money in the money market fund, half of it in this gigantic index fund that has every risky stock and every risky asset in the world. You put all your money in the index fund, none of it in the money market fund. But let's say he wants to take twice the risk you do. So in this world, how would you take even more risk? Because he's already put 100%. Can you go above 100%? You can essentially borrow money. You don't even get fancy. Just borrow money and put it into that. Do you see in this world the most efficient way to take risk is not to buy the riskiest stocks in the market, but to kind of load up on leverage and essentially buy that same index fund. I know it's an extraordinary conclusion, but it follows from having no transaction costs and no private information. And once you get there, measuring risk becomes simple because the risk of an individual asset to anybody is the risk it adds to your portfolio. It's not the risk of the investment standing alone, but if you have a portfolio already, how much risk will that investment add to your portfolio? And what do we say we're already at now? So what does each of us own as our portfolio? We all own the market portfolio, right? So in the CAPM, the risk of an individual asset then becomes the risk it adds to the market portfolio. Almost there. We made a bunch of leaps of faith to get here. Assumptions that are all patently unrealistic. But with those assumptions, and if you follow all the way through, the risk of an asset then becomes a risk it adds to a portfolio. You're saying, what does that even mean? The risk an asset adds to a portfolio will be a function of how much that asset moves with the portfolio. So if you have an asset that is completely independent of the portfolio, like what? One of your investments is going to the racetrack every weekend and putting $1,000 down. The bad news is your expected return is probably going to be negative unless you're a really good horse picker. The good news is the returns on that investment are completely uncorrelated with the rest of your portfolio. So adding that investment, if you want to call it an investment to your portfolio, adds no risk to your portfolio. So I'm going to measure how your investment moves with my portfolio. And to measure that, the statistical way you measure it is with a correlation. How does my stock move with the market? And if I want to make it even fancier, it's a covariance, basically converting that correlation into a percentage number. The covariance of an investment with the market portfolio then becomes the risk added to the portfolio, as opposed to what? As opposed to the total variance. So what I'm saying is, this could be a very risky stock. It has a high total variance, but the covariance of the stock with the market is low. Therefore, it doesn't add as much risk. CAPM originally could have stopped there and said, measure risk with the covariance of your stock with the market. And high covariance is high risk. But what's the problem with covariance? If I told you the covariance of your stock with the market is 22%, it's like the standard deviation. You say, I don't know whether that's high or low. So here's the last step. I take that covariance number for every stock, and I divide each of these covariances by one number, the variance of the market. What does that do? It standardizes the number. So I take the 22%, let's say the variance of the market is 20%. I divide the covariance by the variance. What I get is the beta. Beta is just a standardized measure of how your stock moves with the market. And once I have the beta, the expected return kind of flows out of it in the CAPM as the risk-free rate plus the beta times what I would make on that market portfolio, which is every single traded asset, minus the risk-free asset. Basically, the term in the brackets is called the risk premium. It's what you're demanding over and above the risk-free rate for investing in risky assets. And the beta measures how risky your individual company is based on how much risk it adds to the portfolio. That's a CAPM. You don't need any indifference curves, but did we make a lot of assumptions to get there? God, did we make a lot of assumptions, right? Every step of the way, what did I do? I stopped with these assumptions, and I admit it. I think I was pretty honest. This is a patently unrealistic assumption, but we're going to keep moving. And if you kept moving to it, at the end, we conclude that betas measure risk. Every time you use betas, remember, you're carrying all this baggage with you, whether you like it or not. Okay? So let's be open about the limitations of the CAPM, because I still use the CAPM to value stocks, and one of the first critiques that somebody has who can't deal with reality is that you're using the wrong model. The CAPM is a bad model. And let me list out the critiques I hear. First is the model makes unrealistic assumptions. Does it? Absolutely. But you know what? That's never bothered me. Because I used to be an econ major in a previous lifetime. And I remember those realistic models in econ class. Remember the ones where you could observe the second derivative of the indifference curve of a utility curve to wealth, and everything will be clear. I remember putting up, when will I ever get to observe it? Nobody ever has, but once you observe it, everything is going to be clear. Given a choice between realistic models that nobody can use or unrealistic models that I can use, I'll take the latter over the former. So that's, I coast by. The second critique I'll hear will be from the guy in the back row, the coward, who puts up his hand and says, your beta could be wrong. I said, really? That's all you think I got wrong? You should see my earnings, my cash flows, they're all wrong. Why are they wrong? Because I'm forecasting the future. If your definition of a model is, I will not use a model if it's going to be wrong, you might as well give up right now. So those two critiques you can deal with. The third critique, though, cuts to the bone. What do we say a good model is? A good model should be able to explain what's actually going on. And if the CAPM is the right model for risk, beta is the only measure of risk you need. And if I look across a long time period, beta should explain differences in returns across stocks or risky assets 100%. So over a year it might not, but over 25, 30, 50 years, if the CAPM is the right model of risk, beta should measure the substantial portion of the variation in returns across stocks, because it's the only risk measure that matters. I'll give you the number that should terrify you, 8%. You know what that is? That is the percentage of the variation in returns across investments that's explained by betas. Let me put it more directly. We're using a model that does not explain 92% of what's going on in returns. Now do you see why once this critique comes out, you're going to be paralyzed? How come you're using a model that doesn't? So I'm going to give you a way to get past this critique. Tell them a story. Nice thing about anecdotes is by the time you're done, they've forgotten the question, you can move on. Tell them about these two guys who go camping. Late at night, they're sitting around a campfire. They hear the sound of a crazed grizzly coming at them through the forest. They can hear animals screeching, other campers screaming. So one of the campers gets into his sleeping bag, zips up, and gets ready to die. I don't know what form this takes, but he says, forgive me, God, for all the bad deals I've done, or whatever he's sorry for. And the other camper starts jogging in place, warming up. The guy in the sleeping bag says, what are you doing? He says, I'm warming up. I'm going to run. The guy in the sleeping bag says, You can't outrun a grizzly. They run 55, 60 miles an hour when they're crazed. The guy who's warming up says, look, I don't have to outrun the grizzly. All I have to do is outrun you. It's a morbid thought, but kind of hang in there. You're saying, what's this got to do with the CAPM? It's true the CAPM is an awful model, but remember what Winston Churchill said about democracies? It's a terrible system until you look at the alternatives. The CAPM survives because its competition is so abysmal. So let's look at the competition, because the CAPM came out in 1964. Bill Sharp and John Lintner won the Nobel Prize in the 90s for the model, 1964. And for the first period of time, until probably 75, 76, it was the only game in town. It's a CAPM or nothing. And obviously when you're going against nothing, the CAPM wins. In 1978, a professor at Yale, Steve Ross, said, this is crazy. I agree that we should measure risk as risk that you cannot diversify away, but that non-diversifiable risk comes from a lot of different places. It could be interest rates, it could be inflation, it could be GDPs growing, Basically all these are macro factors, but it could be lots of different sources. We're trying to capture all of that exposure with one number. So it's the question, why don't we allow for multiple sources of non-diversifiable risk or market risk and estimate a beta against each one? When he first came up with this idea, people said, that's nice, but how will we know how many sources of market risk there are, and how will we ever come up with a beta? He said, that's easy. Give me a powerful computer and 50 years of stock returns, and they did. And he put the computer on a search mission. He said, go through the data looking for common patterns. He's saying, why? How do I define market risk or risk that you cannot diversify? It's risk that affects most or all companies at the same time, right? So he said, hey, take a look at the data to see if you can find patterns where 800 stocks seem to move together for whatever reason. It's called a factor analysis. It's a statistical approach. Basically, the computer ran through the data and came back with two pieces of output. First, it said, we found 5 common factors, 5 things that seem to recur over time. And here's the bonus. It gave you the beta for each stock against each of the factors. So basically, we've replaced one beta in the market portfolio with 5 betas and 5 factors. That's called the arbitrage pricing model. When it first came out, people thought this was a godsend. But it never quite caught on. And to see why, let me take you back to 1979, right after this model comes out, and let me play the role of a banker trying to sell you on this model. So you're Pepsi, the company. I'm your banker, and I'm trying to convince you that this new model's come out that's a better way of estimating your hurdle rate. So I walk into your office and say, look, we have this new model. It's called the arbitrage pricing model. And based on that model, your hurdle rate should be 22%. Remember, the hurdle rate is what you need to make. So you're shocked because you always use 17%. The late 70s, people were using high numbers, but you never use 22. So what's the first question you're going to ask me? Why is it so high? And I say, well, that's because you're very sensitive to the second factor. What's your next question going to be? What the heck is the second factor? And I tell you, look, I don't know, but be very careful when it's around. Do you see what happened when factor analysis is a statistical approach. When it comes back and tells you there are 5 factors, you know what it calls them? Factor 1, factor 2, factor... Statistically, it doesn't know. Can you imagine trying to sell Pepsi on using a 22% hurdle rate, and I tell you, you throw me out. And forlorn, I walk back to my office. It's 50 miles away, but I have nothing better to do. And as I walk back, I think about why my pitch did not work. Why didn't it work? When you asked me what the second factor was, I couldn't come back with a name. See what the next step was in this process? If you could just put names on the 5 factors, you're going to be home free, right? Of course, the names have to be macroeconomic names because these are market risk factors. And for the next 6 years, people spend millions of dollars in both academia and practice trying to put names on the factors. Saying, how did they do it? They looked at past data. In fact, when you run a factor analysis, you get a graph of each factor over time. So they looked at macroeconomic factors. They tried, in the old days, like putting transparencies on top of that looks a lot like interest rates. It took them 7 years, but at the end they put names on the factors. And when you put macroeconomic names on the factors, you've just gone from what's called an arbitrage pricing model to what's called a multi-factor model. So now 86, I'm going to show up at Pepsi again. I'm going to try to sell you on this new model. I said that arbitrage pricing model, I don't know what I was thinking. But we come up with an even newer model. It's called the multi-factor model. And based on it, your hurdle rate should be 21%. It's still high, so you ask me why. And I say it's because you're very sensitive to the second factor. But this time, I'm ready for the follow-up question. In fact, if you don't ask me the question, I'll ask myself the question. What is the second factor? And I tell you, it's oil prices. You say, what? We don't use any oil in Pepsi. It might taste like we do, but we have nothing to do with oil. But you can see what happened, right? How did those researchers fit the factors? They looked at the past. And the 1970s were a period where oil prices were a big factor driving stock prices. They did their job. They fit the data to reflect the past. The only problem is by the time you got to 86, oil prices had ceased to be a factor. And this has always been the weakness of multi-factor models, is it's great to fit the past. But to forecast the future, the factors keep changing, the weights keep changing. So neither the arbitrage pricing model nor the multi-factor model was able to kind of push out the CAPM. The CAPM survived. Then you get to the early 90s. And two professors at the University of Chicago, Ken French and Gene Farmer, said, this is stupid. Why are we even trying to build a theoretical model? Why don't we let the market tell us what's risky and what's not? He's saying, how would the market tell you? They went back and looked at 30 years of stock prices, 62 through 91. And they looked at what types of companies earned high returns and what types of companies earned low returns over that period. They found that small market cap companies earned much higher returns than large market cap companies. And then they made a leap of faith. They said if small market cap companies earn higher returns, it must be because markets think they're riskier, so small cap stocks are riskier. You see why this is a leap of faith? Essentially, you're assuming that markets must be right over the long term. So small companies must be riskier than large companies. They also found that stocks where the market cap was well below the book value, low price to book stocks, earned much higher returns than high price to book stocks. And they said, well, if that's the case, then low price to book must be a risk measure. I call these proxy models. You see why they're proxy models? You've given up on measuring risk. You let the market tell you what's risky by looking at the characteristics of companies that earn high returns. And over the last 25 years, as more data has come in, people keep finding new proxies or momentum. So now we have an entire cottage industry of investment funds that are built around factors. Invest in small cap stocks, invest in low price to book stocks. But if you bought into Farmer French, their point was you're not making excess returns. These are just risk measures. We don't know what the risk measures are, but they're measuring risk. So if you tell me what type of company you are, I'll tell you what your hurdle rate should be. In fact, they built a regression model where if you tell me what your market cap is, you plug it into the model, and you tell me what your price to book ratio, you plug it into the model, say your hurdle rate is 14%. Why? Because you're a small company with a low price to book ratio. You say, but I've guaranteed contracts. It doesn't matter. Proxy models, it's a karmic view of risk. You are what you are. Your risk reflects who you are. Nothing you can do about it. So the CAPM survived the arbitrage pricing model, it survived the multi-factor model. It even survived the proxy model. You know how? By building the proxies into the model. So when you see hurdle rates for small companies, now here's what you would see. Risk-free rate plus beta times risk premium plus a small cap premium. Why is it in there? The proxy model. So in a sense, the CAPM has survived because it has adapted. It has adapted and built in all this data, and it survives for a very simple reason. It's a simple model. How many numbers do I need to estimate for a company to use the CAPM? One. Because the risk-free rate and the equity risk premium are the same for all companies. So if you ask me what you got, I need one beta. Why would I want to use a multi-factor model with 5 betas if it works if it works only as well as a CAPM? And all of these models, when it comes to predictions, are lousy models. Why? Because you're forecasting the future. The future reflects shifting taste, shifting factors. So the CAPM survives not because it's a perfect model. It's not even close. Not even because it's a very good model, because it's not very good. Not even because it's a good model, because it's not good. But because it's the best of models that's out there. And when people critique the CAPM, they have an ulterior motive. Most managers say, I don't like this beta thing you're doing. You know what they want to use instead? Their gut feeling. And you know what the R squared between gut feeling and returns is? You think 8% looks bad, you should see what the correlation between gut feeling and actual returns is. So don't tell me, trust me, I've been working in this business for 30 years, therefore I know. Unless you're some idiot savant. Is that even a politically correct word? No, I don't know what the right politically correct word is. So translate it if need be. Who can divine what hurdle rate should be by looking at a project? This is the best we have. Maybe as data comes in, I'm not stuck with betas in the CAPM. I would abandon it in a minute because to me this is a means to an end. I need a hurdle rate. So I keep my eyes open. What can I do differently? But I think that we have to accept the reality that the CAPM is a flawed model, and when you use it, those flaws are going to come into the process. So when you look at your company, try to make this judgment. Is the investor in your company, the marginal investor, likely to be diversified? Because that conclusion, we're not done yet, so don't close it. No. This is just closure on risk and return models, because risk and return models are built on that presumption of diversification. So take a look at the top 17 investors, take a look at the percentage held by institutions, make your best judgment and move on. There is no way you can check. Is my answer right? Make your best judgment and move on, because it's going to form the basis for how we estimate expected returns. So now let's talk about taking this model and making it real. And I use this statement, price of purity is purest, is I'm a pragmatist. I'm going to cut corners, I'm going to make assumptions because I have an end game. I need a hurdle rate. I'm not going to get stuck because I don't have a great way of estimating country risk. So I'm going to keep moving when I get stuck. So let's start by looking at the inputs you need to get the CAPM into use. Risk-free rate plus beta times this number in the brackets, which I call the equity risk premium. There are three numbers I need to estimate the hurdle rate for a company. I need a risk-free rate, a beta, and a risk premium. Which of these three should be the simplest? Risk-free rate. Let's get that out of the way, and you're going to see it's not that simple once you leave your safe havens. Then we'll talk about risk premiums, and then we'll talk about betas last. Because I'm convinced that in practice, people screw this part of the process up royally. Let's start by looking at what a risk-free rate is. Remember how we defined risk in the CAPM Mean-Variance Framework, right? The uncertainty about future returns. The definition of a risk-free asset is you know exactly what you're going to make with certainty. That's what makes an investment risk-free. And if you look a little deeper then, for something to be risk-free, it has to meet two conditions. First is the entity issuing the security can have no default risk. If there's even an iota of default risk, then you're sunk. There can be no default risk. And second, there can be no reinvestment risk. Let me explain what I mean by no reinvestment risk. Let's assume you want a risk-free rate for a 5-year cash flow. A 3-month T-bill is not risk-free if you're looking at a 5-year cash flow. Why? Because at the end of the 3 months, you've got to reinvest it. What rate, you don't know. So you're saying, why not a 5-year T-bond? Even a 5-year T-bond is not quite risk-free because you get coupons every 6 months, which you have to reinvest, and you don't know at what rate. So if you're a purist, here's what you would do. You would take each cash flow, and you would find a 0 coupon bond because the coupon screwed up, and you take a 0 coupon bond rate, and you would use that as your risk-free rate for each cash flow. So year 1, you'd use 1 year 0. Year 2, you'd use the 2. Is it doable? Yes, we have the data now, but what a pain in the neck. So I'm going to suggest a compromise that I'm going to stick through all of the rest of this class. I'm going to say, look, I could go look up a 1 year, 2 year, but I'm not going to do that. Instead, I'm going to do a version of what's called duration matching. The old banks used to manage interest rate risk by doing duration matching. And what that meant was they take the duration of their liabilities and try to match it up. Instead of matching each asset to a liability of equivalent duration, which would be the perfect way, they'd say the average duration of our assets is 14 years. We're going to try to make the average duration of our liabilities 14 years as well. It's not perfect, but it gets you close enough. And in corporate finance, as well as in valuation, because we're looking at cash flows in the long term, I'm going to argue that my risk-free rate has to be weighted towards the long term. In fact, I'll make it even simpler. If I can find a 10-year default-free rate in your currency, I'm going to use that as my risk-free rate for year 1, year 2, even though I know it's not perfect because it's close enough. So all I need is a 10-year default-free rate, right? So let's start easy. Let's assume I want a risk-free rate in US dollars today. What would I use as my risk-free rate? You're saying 10-year T-bond rate, right? Which right now is about 2.65%. But implicitly, what are we assuming about the US Treasury when we do that? There's no default risk. And that's an assumption because it's not a guarantee. Remember in 2012, S&P went through this entire summer of downgrading the US and saying there's default risk here. If you make that assumption, the risk-free rate in US dollars is going to be the 10-year rate. And one of the things I'm going to argue is, when you talk about risk-free rates, you can't use a US dollar risk-free rate if you're doing your assessment in euros or Indonesian rupiah rupees. Your risk-free rate has to be in the currency in which you decide to do your cash flows in. So if you're GE looking at a Chinese project and you're projecting cash flows in yuan, you need a yuan risk-free rate. You're saying, well, that's easy. Let me go find a government bond in that rate. In the US, we made that leap, right? A government bond rate must be risk-free. But that can be a dangerous leap if you have a government with default risk. So if I wanted an Indonesian rupiah risk-free rate, I could find you a 10-year Indonesian government bond denominated in rupiah and give you the rate. But the problem is that rate might not be risk-free because embedded in that rate might be a spread for the fact that this country. You're saying, why would a government ever default in its local currency? What's the argument people use for why governments should not default in their own currency? What's the power that governments have? They should be able to print currency, right? But here's the counter fact that you have to then deal with. Over the last 30 years, 51% of all sovereign defaults have been local currency defaults. So how do you explain that? Why would governments, if they can print the money to pay off the debt, ever choose to default? What's the price of running a printing press is faster than paying off the debt? You end up with debasing your currency. So basically, you're between a rock and a hard place. Would I rather default or would I rather debase the currency? And over the last 25 years, we've discovered that it might be easier to come back from default than from debasement. What I mean by that, I first started going to Brazil in 1997. When I first went to Brazil, it was 5 years after hyperinflation. It essentially made the reais inflation rate 5,000%. It took 15 years after that hyperinflation for either Brazilian companies or the Brazilian government to issue long-term bonds in reais because nobody would buy the bonds because they didn't trust the real. That's what debasement does. In contrast, look at Argentina. In any just word, where would Argentina be? Nobody would ever invest in Argentina. This is a country that defaults every 4 years. Every 5 years. It's like, when I was in Uruguay, somebody asked me, we have Argentina as a neighbor, how should we think about it? I said, think about Argentina as a crazy uncle living in your attic. A very nice guy when he's in a good mood, but goes crazy every 3 or 4 years. Okay? But the thing is, in 2015, I was in Argentina. It was like the second coming of another great market. People were flocking into Argentina saying, now's the... So default seems to be easier. It might not be fair, but the reality is governments do default. So if you have a government that is default-free, you can do what I did for the US dollar. Take the government bond rate and use it as a risk-free rate. But if your government can default, then you have a problem. You've got to clean up that government bond rate for default risk. So let me set up the process. The US dollar, I said that the risk-free rate is the T-bond rate. And we'll make the assumption. Let's assume you're looking at a European company and you decide to make the euro your currency of analysis. Currency is always a choice. You can analyze any company in any currency. But it's probably easiest to do it in the currency in which it reports its financials because then you don't have to. So let's say you're looking at a Spanish company. Is your project. Some of you might pick Spanish companies. And you need a risk-free rate in euros to use to assess the company, to come up with a hurdle rate. Well, you could use the Spanish 10-year bond rate. And these are all 10-year governments, 10-year government bonds, all denominated in euros. This is in 1998, where you have pesos and lira and francs. This is all euros. I could use the 3.95% as my risk-free rate, but what's the problem with doing that? These are all government bond rates in euros, and if they're all in euros, the only reason the Spanish bond rate is higher than the German bond rate is because there's default risk. You can't have a risk-free rate with default risk. So if I'm looking at a European company in euros, what should I use as my risk-free rate? I'm going to use the German. And the reason I do it is not because I'm particularly attached to the Germans. I'm not. It's because it's the lowest rate. I'm completely agnostic. If 10 years from now the lowest rate is the Portuguese 10-year government bond rate, miracles can happen, I would use the Portuguese rate. This is not about German or Portuguese. It's about finding something risk-free. You're saying, but I want to punish the Spanish company for being Spanish. I'll give you lots of chances to punish companies for being Spanish or Greek. Okay? But it's not going to be in the risk-free rate. It's going to be the German bond rate. Yeah.
Why wouldn't you use the
ECB rate. You could, because even the problem with the euro, of course, is you've given up power over your printing press. So even the German government has a tinge of default risk in it, right? You could use the ECB rates, which are very close to German rates, but they're very lightly traded relative to the German bond. So basically, I've gone with the liquidity argument, but if you use the ECB rate, you'd get a rate very close to German bond rate. But that's, again, the same rationale. You want to get something risk-free in that currency. You think, what if I'm doing a Russian company in euros? Still, you'd use the German euro bond rate. I've made your life very simple. I want to do a Brazilian company in US dollars. What's my risk-free rate? Don't think too long. It's a T-bond rate, not the Brazilian 10-year dollar-denominated bond. Once you pick a currency, the risk-free rate has to be in that currency. So these are all default-free governments. How did I find that? In November of 2013, I trusted Moody's. It's a dangerous thing to do, but it saves me a lot of time. I took every AAA-rated government and said that's default-free because that's what Moody's says AAA stands for. And if I trust that, there are my rates in AAA-rated currencies in November of 2013. And those would be my risk-free rates, ranging from Japanese yen to Australian dollars. Let me do one final thing and then we'll end for the day. But what if I have a currency with default risk? Remember, two of my companies, Baidu and Tata Motors, one is in rupees, one is in Chinese yuan. I have to get risk-free rates in the local currency or cheat and do everything in dollars, but I want to deal with the local currency. I want a risk-free rate in rupees. So here's what I started with. I would look for a 10-year government bond issued by the Indian government in rupees. And I found one. 8.82% was the rate in November of 2000. I'm home free, right? Not quite, because I have to stop and make sure that that is default free. And when I stopped and checked, I got some bad news. Because when I went to Moody's, if you go to Moody's and look under sovereign ratings, it lists two ratings for every country. A foreign currency rating, which is the default risk they see in your country when it borrows in a foreign currency, and a local currency rating. And I think, please God, let me see a AAA rating under the local currency rating for India, because then I'd have used the 8.82% and trusted Moody's and blamed them if something went wrong. What I found instead was a Baa3 rating. Not a horrifically bad rating, but clearly Moody's is saying there's default risk in the local currency. And a Baa3 rating translates into a default spread of about 2.25%. You're saying, where are you coming up with these default spreads? I'll take you through that process in more detail in the next class, but basically it's, I have a lookup table. You tell me what your sovereign rating is. Say, this is your default spread. There are market set measures now you can look up. Sovereign CDS spreads, for instance, are measures of default spreads, but I'm taking out the default spread to come up with a risk-free rate in Indian rupees, 6.57%. That's what I'm going to use as my risk-free rate. For Chinese renminbi, basically I took out the default spread for China, which is much smaller because its rating is higher, and end up with a risk-free rate in renminbi. And you can do that with any currency. I trust some currencies more than others. If the government bond rate is not reliable, it's going to, for instance, the Venezuelan government claims that the 10-year Venezuelan Bolivar government bond rate is 19.4%. Come on, in what universe is that going to be true? It's a country with, 500,000% inflation. Would you buy a government bond which promised you a 90? I would. But the Venezuelan government passes off numbers like that. That's our government bond rate. If I build from that, I end up with a risk-free rate in Bolivar of about 4%. If you don't trust the local currency, you cannot find a risk-free rate, then do what I suggested. Pick a different currency, or even do things in real terms. We'll talk about how to get a real risk-free rate and work through. But the TIPS rate is in fact a good proxy for the real risk-free rate. So when we start class on Monday, I'm going to start with a question. I want you to think about this. The risk-free rates we're going to get in different currencies are going to be different. Stating the obvious, why do risk-free rates vary across currencies? So that's your question for the weekend. I want you to think about it. Why do risk-free rates vary across currencies? Because we'll start with that question. Yes.
Question for you. This was actually on valuation. I was just running through. I noticed you had consistent 2.67% ongoing. Yeah. Okay.
Not everybody's going to do it.
Gotcha.
You wait 5 minutes, you want to change that, then you take all the cost of capital
Yep.
and the lower rate. So basically, altogether,
Which is an easy way to.
it's an easy way to get there. The next 5 years, you do whatever you want.
Yep. Okay. Thank you.
Covering what you brought about the data, where you only indicators for like 14,000 stocks. Is that this year? Is that available?
That's what I think we take to do inside. We know that this is country specific. We're going to stop you from using the data. Why don't we use that? So if you look at my industry, that's one position that sometimes you have to know. And second, any company, even if it's data that I compute, you can't take, so I can't report for instance present value, not on the S&P website, but I can't take their raw data, compute it, so no company specific data. But to me that's not an issue. So I don't need to take up the data analysis. None of the data is on report, it's all public. Exactly. If you have your annual report, all of the data is yours. Because I lay out the process that I do. And in fact, what you're doing is with the company, you can make much more finesse with something. Because I was doing this for 45 companies, I assume, for instance, all R&D is a 5-year life, which I don't have to do if I'm looking at a couple of companies. Company R&D might be 10, technology. I assume that every company is going to leave commitments after 5 years, run for an extra 5. Whereas on the company, some companies might run for an extra 2, some might run an extra 8. So the company-specific data you will not miss if you're looking at individual companies.
Okay.
But if you're trying to pull up 150 companies, then obviously, but that's why you have access to the IC data too. You can pull the raw data on 150 companies if that's what you want.
So it's not going to the data.
It's not a problem.
One more thing.
Yeah.
Just to see if I understood this. The risk-free rate being higher in more undeveloped countries makes it.
It's not necessarily undeveloped. I mean, that's the question I want you to think about. If that's your answer, developed countries have low risk-free rate. You know, the U.S. had a T-bond rate of 11% in 1979. Right? I mean, we forget history sometimes. Developed markets have not always had low rates. And emerging markets don't always, for instance, Malaysia, is 3%. So in a sense, it's not developed emerging. So that's not the answer.